just over 8 million shillings. So it's a huge amount, and it's really made an impact in the lives of these children.
I&M Bank, before the foundation, has also helped us in construction of classrooms in another school, again in Machakos county, and they made a difference because solid classrooms means more populations coming in, and these are children who are so vulnerable. And then the feeding program started, so the populations increased.
So one student, a girl, who was supported by I&M, recently graduated. She finished last year, but she had a formal graduation last week. She came from a family that was abandoned by the father, and the father told them never to look for him again. After she finished Form 4, she had no hope of going further. But because of I&M, she was able to go to Kibondeni and do hospitality. And today she's a pastry chef at Kofisi Square. And she's so excited because without I&M support, or without Amara stepping in, she would have never made it to that position. And now she's able to support her younger sister.
So our relationship with the I&M Bank and the foundation has really grown. I guess they trust us because we are so transparent, and over the 17 years, our relationship has become stronger. They feel confident that they can offer scholarships for our children to have a better future in their lives. So they've done amazing.
I&M, the future.
Over 50 years ago, we planted a seed. It wasn't yet a bank, but a promise. A commitment to investments and mortgages that would eventually shelter the dreams of a nation. Throughout the 80s, that promise matured. We didn't just hold funds, we built trust. By the time the mid-90s arrived, we were ready to evolve. We transformed from a financial institution to a fully fledged bank. This was our first great metamorphosis, a signal to the market that we were here to stay. As the new millennium broke, our ambition took physical form. We redefined the Nairobi skyline with our iconic tower, a symbol of our permanence and strength. But the skyline was not enough. We knew that true growth meant breaking boundaries. We began a decade of strategic unification and exploration. We merged with partners who shared our values and looked beyond our borders. We crossed the ocean to Mauritius. We stepped into Tanzania. We made our mark in Rwanda. We were no longer just a Kenyan secret. We were becoming an East African powerhouse. We listened on the Nairobi Security Exchange, inviting the public to share in our success, and we entered the insurance space to protect the wealth we helped our clients create. As we approached our mid-40s, we didn't just expand, we refined. We adopted the Amara strategy, a blueprint that sharpened our focus and digitized our soul. We made strategic acquisitions to consolidate our strength, bringing new partners into the fold. The market took notice. Our relentless pursuit of excellence propelled us to the coveted Tier 1 status. We had just joined the elite table, not by chance, but by design. We diversified our portfolio, rebranded to reflect our group status, and completed our regional circuit by establishing our presence in Uganda. Today, we stand on the shoulders of that history, but our eyes are fixed on the horizon. We are no longer just building banks, we are building a sustainable future. From the cutting-edge eco-design of First Park Avenue, we are proving that financial success and environmental stewardship go hand in hand. We have diversified into wealth management, ensuring that the prosperity we generate lasts for generations. 50 years ago, we started with one single step. Today, we are a regional giant, driving business and empowering lives across East Africa. This is our story. This is our legacy. And the best part is, we are just getting started.
Doing good, bega kwa bega, shoulder to shoulder, steadily we grow. I am in the future. Doing good, I am in the future. Steadily we grow. Now and the future. Bado tunasonga. I am in the future. I am the future.
I&M Bank.
Mbali tumetoka na bado tunasonga.
Kenya Forest Service is an institution established by law. It is a fairly new institution that came into being in 2007, and our main role is to develop, manage, conserve, and protect forest and tree resources and all allied resources for social economic development and for future generations.
The forests I manage within Nairobi are all urban forests, and here we are in Ngong Road Forest is one of them. Actually, Ngong Road Forest is the biggest green space or urban forest we have in Nairobi. It is divided into 5 blocks. Sanctuary, where we are, is the biggest block with 695 hectares, and we have another block called Miotoni, Karen block, Bomas block, and Lenana block.
Kenya Forest Service, as a government institution, faces a myriad of challenges in terms of achieving our own mandate as an organization. So what are the challenges? The main one is encroachment into our forests, alteration of boundaries because of certain politically motivated intentions. We also have insecurity in some of our forests arising from organized crime. And in fact, some of them that are transboundary in nature. Then we have security threats, some of them even terror threats in some of our transboundary forests. So, but the biggest one is climate change.
So the partnership we have with I&M Foundation is an exciting one because we'll have our largest block fenced, which is our biggest natural forest in Ngong Road. So on this project with the I&M Foundation, we kicked it up by doing public participation. We did it with the Langata Sub-County, Dagoretti Sub-County, and Kibra Sub-County. And in all those sub-counties, we have community that have formed. They form a social fence, and when we bring our fence now, the electric fence, supported by I&M Foundation, it will be the second fence, and that will add value to this forest, especially when it comes to challenges that this forest has been having.
Fencing brings about security. And when we have security, then we can have more visits and more Kenyans can enjoy the ambient facility that is here.
To back up that, the fence also needs the rangers, of which we have about 24 rangers in this forest, but accommodation is an issue, and the I&M Foundation has also come up with a solution, and it's building for these rangers houses. Other things like water is a problem. The borehole will come up within this project. They are also going to add value, so we thank I&M Foundation for their initiative to partner with Kenya Forest Service.
I&M the future. Mbali tumetoka na bado tunasonga.
I completed my primary school education at 2020-2021 during Corona period, and I scored 353 marks.
Nilimsomesha kutoka darasa la kwanza mpaka akamaliza darasa la 8. Alafu akimaliza darasa la 8 nilisikia kuna hiyo shirika na nikasema wacha ni apply nione kama nitaweza.
If I remember well, after kupewa hiyo letter ya kwenda the school that I was talking about, my mom hakuwa na option, aliniambia utaenda huko juu surely hadi hiyo shule yenye unataka kwenda she's raised the school fees. And about my mom's raising fees, truly I can just say to you, no lie, angeweza kumanage 80k. It wasn't a joke, ilikuwanga mingi kwake. So it was full scholarship. Apart from we were paying 5,000 per term, and shopping and pocket money was ilikuwa inatolewa na mzazi. Yeah, but the school fees 80k was fully covered. So I&M Bank imenitoa mbali.
Mimi matarajio yangu ya future yake nataka akuwe na maisha mazuri akimaliza masomo yake yote.
The message that I'm passing to all girls, just work hard. The I&M Bank Foundation is looking for you to support you.
Nataka kushukuru St. Anne High School Girls and na I&M Foundation.
I&M, the future. Mbali tumetoka na bado tunasonga.
Amara Trust started with a group of friends. We used to be doing donations, little ones, but we felt to be able to do more and be taken seriously, we needed to have it registered so more people can come forward to help us. So I met Sarit Raja of I&M Bank. We met very casually at a wedding function, and just casually asked me what I was up to, and I said, this is what I'm doing. Amara Trust has happened, and we are looking for funds for education. At the time, we could only do little things because we didn't have much money, so whether it was giving them food once in a while or stationery. So when they came on board, which was quite immediate, he says, come and meet me at my office. And I think the following week made an appointment, met up with him, and straight away, without any hesitation, said, we are going to hold your hands, and decided we'll help you with the construction that we were looking at. And that's how our journey started.
I was one of the founding trustees with Vasha, Smita and Priti, and we decided that we wanted to work outside Nairobi in terms of educating students, empowering and enabling them to have better lives, and mainly to get out of the poverty cycle and educate themselves and do something better for their lives and their families.
So we started with Machakos because it's pretty close to Nairobi, and I think rural Kenya has much less help than Nairobi does. So Machakos, and now for the last 3 years, we're in Kajiado as well.
We started off with the food program, construction. One of the prongs is helping them with learning materials. And then eventually the trust grew into changing and evolving with different aspects of the work we do. And we started the Education Fund program in 2020. That's where the I&M Foundation joined hands with Amara to empower the students.
The Education Fund program was primarily to create opportunities for students from underserved communities and give them an opportunity to finish high school, and for those who finished high school to then go on to get a technical skill. So we target students from secondary schools where we have partnered before in terms of construction and feeding programs, and then we go down and interview them after their KCSEs, and we take students who have come from really challenging financial backgrounds, from families with many siblings, single parent families, orphans or abandoned kids. And we take them through an interview process. They're selected by their teachers and we interview them. We give them technical courses to choose from so they can learn hard skills and either become a business person on their own or look for employment. Those are the TVAT programs. We also support students through secondary school for the 4 years. So at the moment we have taken 135 students through our technical program. And then we have 76 students we are supporting through secondary school. Of those 76, 23 have transitioned into our TVET program.
So what happens at the TVETs is the TVETs have been vetted, and we send them to learn courses like hairdressing and cosmetology. There are plumbing courses, there's automotive, there's catering and housekeeping. We've got fashion design students. So the success rate for Amara for graduates is 89%.
We partnered with INM in 2022, September. That year we had 28 students we interviewed. They said they would support us up to 5 million.
Over 50 years ago, we planted a seed. It wasn't yet a bank, but a... Over 50 years ago, we planted a seed. It wasn't yet... Over 50 years ago, we planted a seed.
So let me take this opportunity to call us to order. We want to start our very brief program. We have colleagues, we have customers, we have guests joining us online as well. So we will be kicking off the official program. There's always something very interesting about the financials, and especially when you come in as the last one. Yeah, there's a bounce when you know that the results are good. There's an energy that I'm feeling in the room. So we're looking forward to a very exciting conversation this morning. We'll run the program very smoothly. We'll kick off with our regional CEO, who's also our interim CEO, Kenya, giving us a bit of an overview of how we performed as INM Group. We'll also hear from our CFO, talking us through the numbers, and we'll have a discussion from the different businesses that we support. So again, karibuni. For those joining us online, welcome to the 2025 INM Group Financial Briefing. And at this point, allow me to invite Mr. Kihara. As Kihara comes up, let me recognize our executive leadership team who are in the room. Perhaps just quick stand. We have our executive committee. Right from this table, we have Mr. Shivlin, our director for business development. We have our CFO, David Ngata, not a new face. We have Gauri Gupta, who's our director for investor relations and sustainability. We have our group director for digital business, Eunice Gatama. On the other table, we have Shamiri Patel, who leads the retail and business banking business at INM. We have Henry Runania, who leads our global markets business. Evans Brown, who leads our products business. Sandeep, who's our director for credit. And we
Thank you, Mary. Thank you, Mary, and good morning, everybody. It is really an honor for us to be with you here today to discuss our performance in 2025, and welcome to all of those who are online, joining us online. We'll go straight into it. So let me begin with a picture of our regional footprint. This is unchanged from when we last met, only in terms of geography, but in terms of numbers, there has been some significant changes. You will see that we now have 119 branches across our network, 71 of those in Kenya, 12 in Uganda, 20 in Rwanda, and 8 apiece in Tanzania and Mauritius. The customer numbers as well have grown quite significantly at over 900,000, so just under 1 million. And actually, we say over 3,500. It's actually better to say we have 3,601 wonderful colleagues who have actually delivered the results that we've had this year. And we're really proud of the work that they have done. We've got over 6,000 shareholders supporting us. We've seen some significant moves in our share price last year, and that is testament to the support that our shareholders are giving us. So let me move to what now must be pretty familiar to you. This is what we call our strategy, Amara 3.0. And our long-term ambition, our strategic aspiration still remains to be Eastern Africa's leading financial partner for growth. We detailed where we see our intended impact, so looking at impacting 10 million lives positively, looking at doing that through ensuring a very good customer experience for all of our customers. We target that through our NPS at greater than 70%. And then for all of our customers who are connected to us digitally, we're looking at them to be over 90% active. In terms of where we seek to participate, very clear that we have our strengths in our core segments of corporate and commercial, and we wanted to entrench our presence there. We're looking at greater relevance in our emerging customer segments of retail and SME. And a very important area that we have been working on for a while is to become a leader in ecosystem partnerships. So to be able to do that, we are supporting these pillars using investments in brand relevance, and we will have a bit of detail on that later, looking at how we can unlock group synergies, ensure resilience in our business, and of course, digitization underpinning a lot of the leadership that we're looking to build in these segments. But it comes down to people, and we have to keep on investing in our people, ensuring that we have the right culture within the organization to deliver the outcomes that we're looking at. We have talked in detail about sustainability, our focus on sustainability, and we'll capture that a bit later. But these are just the SDGs that we have aligned to, and you can see them detailed over there. So in terms of what our aspirations that speak to these pillars are, we'll see that this is looking at our targeting in 2026. We're looking to hit 20% return on equity this year. We want to maintain the level of penetration that we've seen, the number of digitally active customers at over 90%. We want to ensure that our net promoter score is still greater than 70%. And we want to cross the 1 million mark in terms of customers across our network, and at the same time make sure that we have the right employee experience, because this is really ultimately what drives the outcomes that we're looking at. So all of this then, we remember we are doing this to impact people positively. We're looking at impacting over 10 million lives positively. So Amara has been a 3-year journey. Amara 3.0 has been a 3-year journey. We are now in the final year of this particular cycle in 2026, and looking at how we have performed over the past 2 years. In 2024, when we started, we have already positively impacted over 11 million lives, and we are talking here about access to finance and also looking at other pillars like economic empowerment. So in terms of customer numbers, very good growth year on year, from just under 730,000 to just under 1 million in 2025. We have been working on different customer initiatives, And our Net Promoter Score is one of the strongest in the country, if not the strongest actually in our peer set at 79%. And in terms of digitally active customers, that's pretty strong at 86%. So good movement on both, on the three metrics. I mentioned our colleagues. It's really good to see that even as we increase the number of staff that we have across the group, we have maintained our employee engagement. It's at 81% across the group. And this is against the target that we have internally of 80%. So this is really good to see because it means that we are addressing the asks that our employees have for the kind of environment that they need for them to be able to work optimally. In terms of the new initiatives we've had, growth areas we're looking at in terms of business, that has continued to contribute strongly. In 2024, that was at 25%. We've maintained about the same level. Sorry, in 2024, it was 25%. In 2025, at 24%. And we have talked previously about the need to continue diversifying our business, and the level of contribution coming in from our subsidiaries has been at 25% in 2025, but largely impacted by currency movements in the region. Otherwise, it has been strong growth in the individual subsidiaries. In terms of return on equity, we have ticked up from 17% to 18%, and that is really commendable. So against that backdrop, we have looked at a payout in terms of dividend per share coming to 3.75 in 2025, and that is up from 3 shillings in 2024. So a few highlights then across the group. Starting with the region, we are looking at around 5% growth in GDP. Now, we appreciate that there have been some recent global risks that are impacting the way that these predictions are going to play out. But largely, we've seen inflationary pressures actually being moderated across the region, and a lot more stability. During the COVID period and immediately after, there was a lot of challenges with currencies across the region, but a lot of the regulators have been working on managing that, and we have seen stability in most of the currency markets in the region. So if we look at our income statement, we have had strong growth in total operating income. And this is at 19% growth year on year, so to 60.3 billion shillings. This has been driven by an over 30% increase in non-interest income, and this has also been in turn driven by the increase in customer numbers at 33%. We have obviously had to invest in this growth, and our network has been expanding across the region, particularly in Kenya, and this has also driven our operating expenses up, and we've seen this rise by 19%. We have also been spending a lot of our investment dollars in building our brand and making sure that our people are ready in terms of the skill sets that they require to deliver for our promises. This has resulted then in just a marginal improvement in the cost-to-income ratio, and you will see that that is down to 46% from 47% and trending lower. The cost of doing business in these challenging times continues. Provisions have increased by 11% year on year, and that just simply reflects the kind of risks that we are facing in our different economies. And you will see that the cost of risk ratio has increased from 2.9% to 3.2% to 2.9% in 2025 from 2.6% in 2024. So looking, however, at the PBT numbers, you will see that we are reporting 32 billion shillings in profit before provisions, and 24.2 billion shillings in profit before tax, which is 22% growth on year, one of the highest growth rates that we have seen reported in the industry. And this is down to all the hard work that has come from our 3,600 employees, over 50 directors that oversee the business, and over almost 100 people in our senior leadership group that then guide the teams in producing these numbers. Looking at the balance sheet, I have talked to the expansion that we have been driving, but we have looked at our loan book quite cautiously given the kind of conditions that we're operating in. And we've seen an improvement in our gross NPLs. So that has come down from 36 billion to 31 billion shillings. And this has improved our gross NPL ratio then down to 9.8%, and the net NPA ratio has then dropped to 2.9%. But you will see that we've had 15% growth in our total assets to 669 billion shillings. Very, very good growth in terms of customer deposits, reflecting the increasing number of customers, but also the focus on new segments that has then driven significant balance sheet growth also in the corporate and business banking space. So really strong numbers, and looking at this, we have also to keep in mind that the capital needed to support such growth is closely monitored, and you will see that the total capital to total risk-weighted assets has maintained at 20%, and liquidity also very strong at 60% across the group. So I just mentioned our liquidity and capital adequacy. This breaks down how it looks across the various entities in our group, and you will see relatively across the business very high liquidity ratios, and if you compare that against the regulatory minimums, very strong numbers. For the number that we're presenting on the liquidity ratio in Mauritius, we don't actually have a metric like this, but we compare it as an internal metric, and also very strong buffers there as well. In terms of capital adequacy, again, you have different ratios across the different markets that are recommended by the regulator. And in each, we are meeting or more than exceeding our internal buffers that we put in place to make sure that we are well capitalized to support the business growth we are focusing on. So turning to the different segments and how we have performed in each. So looking at the operating income, you will see that corporate banking in 2025 contributed 17 billion shillings over 60 billion shillings in operating income that we mentioned earlier. The retail and business banking also very strong at just 26 billion shillings or so. And very strong contribution coming in from other income. And in this case, we are talking about treasury income, some of the rental income we get from the realty business, and then also very strong performance in our non-banking subsidiaries. If you look at it percentage-wise, you will see a move from 9% to 29% for the other income line. Balance sheet-wise, you will see that corporate and institutional banking muted growth 3%. I talked earlier about the operating environment and our focus on making sure we're writing good assets, but still very good representation at 208 billion shillings. Very, very good growth in the retail and business banking space, just under 100 billion shillings in total assets at 99 billion shillings. The deposit side, while we've seen retail and business banking post 2%, this is, remember, across the group, the different businesses have seen contribution change, even as we adjusted positions in our various markets. But very strong growth, 44% in the corporate and institutional banking space, to reach 220 billion shillings in customer deposits. So breaking down our various pillars, looking at leadership in our core segment, the first pillar, corporate institutional banking. So we've talked about the contribution, but I just wanted to highlight that the sectors that we have been focusing on, the oil and gas sector, the public sector, the China corridor of 4% of the corporate and institutional banking income in 25, and that's up from 20%. So this focus areas continuing to get entrenched, and this is a really good contribution, we feel, into that space. Looking at the numbers themselves, then you will see that we've had some strength in the Kenya shilling, and particularly against one of our fastest growing businesses in Rwanda, which is in Rwanda. We have seen that impact being muted by that currency contribution, but in local currency that has been growing very, very strongly. But you will see that while there was a 12% decline in operating income, we have still seen strong contribution from the CIB space into the total income for the group. Looking at the second pillar, which is retail and business banking, again, here this is where our growth story really is. We have been expanding our footprint in the network. We've been looking at greater acquisition through our digital channels, and we're looking to build scale in this space. So our distribution channels going up actually 12 branches in 2025 and 11 ATMs to support that. But we are looking more at how we can ensure that our customer experiences on our digital channels is really strong, and that the servicing that we are promoting for our clients largely comes through those channels. So if we look at then how much we have supported our customers in terms of financing through digital channels, that's at or just over 20 billion shillings through those digital channels. And this has been a really, really strong story. We have also been supporting deposit growth through the same channels, and you will see the popular campaign that we had last year in Kenya, the Shinda Milioni campaign, which has really excited customers and has helped support growth in terms of our customer numbers. So in terms of contribution, while again here the income contribution would be muted by some of the currency depreciation that we've seen, all of the subsidiaries have shown very strong growth in local currency. And we continue to see some innovations that are very welcome in our customer segments for retail and SME loans, and a great affinity for the brand in accessing these products. So the ecosystem story is one where we see the greatest impact in terms of the lives that we're looking to affect positively. And here we report over 11 million lives that were positively impacted. Ecosystems pillar now is contributing over 8% to our total operating income. I talked about the 20 billion shillings that has been accessed through digital channels. And in terms of just one specific product, short-term loans, we have had more than 5.5 billion shillings that has been disbursed in lending in short-term loans. So really strong story, and it is one that we're looking to build. We've also been focusing on different aspects of the ecosystem, so looking at payment services. I've talked about digital lending. In the remittances space, in partnership with our treasury teams, we have really embedded ourselves in that space. We are now doing over 25% of inward remittances into the country, which is really, really good because of those partnerships that we are building. And we want to make sure that we are relevant to the economies in which we are operating. So we've been working on partnerships that allow us to get into spaces that are truly impactful to the countries, the populations of the countries in which we are operating. If we look at agriculture, we know it is a mainstay for our economies. We are looking at that agricultural value chain and looking at how we can support financing in those spaces, facilitate the movement of money in that space. So in terms of partnerships, we're looking at not just simply de-risking partners, but also at tech partners that can help with the reach that our clients in this space need. And that then means that from an e-commerce perspective as well, we are supporting that ecosystem to make sure that money can move to where the business is being done. So our digital businesses accounted for about 18%, up from 10%, of the retail and business banking total operating income. So in terms of the digitization story, we have continued that right across the group. And out of the total capex that we had targeted and actually spent in 2025, over 50% of that has been on our technology platforms, looking at enhancing the customer experience, making sure that our systems are stable, and ensuring that the servicing, the engagement actually happens on those channels. So over 91% growth in the number of accounts that have been opened digitally, at over 155,000 of the numbers that we saw earlier in customer growth. This has also translated into a key part of asset and liability management, which is increasing our current accounts and savings accounts mix in the balance sheet. And this has seen an uplift of over 11 billion shillings in CASA balances. In terms of transactions, again, as talked about servicing our customers on these channels, we've seen over 50% growth in the number of transactions that are being done monthly on our channels, and that has now moved to about 5.5 million transactions monthly. When we look at the number of digitally active customers, that again I had mentioned was up to 86%. We are targeting to grow this past 90%. So when we say that we're looking at that digital engagement to increase, you can see that it is working. At 69% of new to bank accounts being opened through digital channels, and our total revenue from digital channels increasing by 231%. And you will see the graphic on the bottom right. This really speaks to one of the most endearing brand assets that we have. You will recall, coming from the COVID era, there was a lot of focus on making life easier for our customers throughout the banking industry, and the Nisare Kabisa campaign sought to reduce the burden for our our customers, and this has continued to grow from strength to strength. We've not only done it in the personal banking, now extended it into what we call sort of biz, which is your individual or sole proprietor businesses. So we carry that cost burden on behalf of our customers, and it is reciprocated by them actually coming on board, signing up with us, and transacting through because with over 3,600, I think it's easier to say 3,601 staff in the network in 2025, to see that our engagement profile is strong at 81%, and that the gender mix is moving in the right direction in terms of the mix we've seen. It's now 50-50. Don't ask me how it's 50-50 when you're dealing with an odd number, right, of employees, but we're averaging over here. But also positive movement in senior leadership, which is really exciting to see. And you will have seen that representation from the people who were introduced this morning. The number of females in senior management has gone up by 5%, which is also aligned to the strategic development goals that we have signed up to, including also partnerships like the UN Global Compact. So this against the backdrop of 11% growth in staff numbers, and we are continuing our initiatives on deepening engagement within the staff body, and that comes through driving training. So you will see the focus on training. So average training days up 11%. But one key accolade that we got last year was the top employer recognition, which captures exactly what kind of environment the business has for staff. And this was something that we announced at the beginning of the year. And the top employer accolade really singles out organizations that are driving the right kind of environment for staff. I talked earlier about our investment focus, and brand is a key area for us in that regard. We appreciate that we have to tell our story, we have to build our brand so that we can then drive awareness, move it to consideration, and eventually to usage. So here we have spent just under about 1 billion shillings of our, and which is about 3% of our total operating expenses on brand activities. And we are looking at creative ways to do that. So it won't just simply come from just the marketing spend. It's the whole range of activities that we are undertaking in our different initiatives. So if you look at last year, we had the campaign on the I&M Foundation at 5, which showcased what we are doing in the social investment space. And this whole bucket of activities has driven our brand awareness up. At 42%, this represents one of the highest brand awareness scores in the industry. We are reporting a study here that actually looks at the entire industry. We haven't commissioned them. We actually just simply use their information. So this is really good to see. And relevance, as reported in the company that has done this, is Consumer Insights. So this is their 2026 report released this year. It shows that we are emerging as the most preferred bank by customers. So this is really good and tells us that the work that we are doing to promote the brand and drive positive outcomes for our clients is working. Now, looking at sustainability, we have become more deliberate about how we measure this. So we're looking at the usage of resources and driving efficiency in the use of those resources. So we tracked 7% decrease in energy consumption per employee. That's quite a challenge, given that we have also increased the number of employees in the business. So this is good to see. At the same time, we've been looking at our digitization and automation efforts and how they can reduce paper in the workplace, an 11% reduction. We look at the waste that we generate across our footprint, and how much of that we recycle. And we're recycling 98% of that, and that includes electronic waste. So we encourage not just our staff to bring in their e-waste and drive recycling, but also our customers. And you probably have seen some of those in our different workplaces where we're encouraging the collection of devices that are no longer useful. We did see an increase in water consumption. I'd like to think that that's because people are drinking more water. But we do appreciate that some of these numbers have a bit of noise. But generally, we are making sure that we are also looking at efficient use of water. So in terms of enhancing the quality of life, making sure that people have spaces, particularly in urban areas, that they can go to get some respite from all of the daily chores that they have. We've been looking at how we can improve these spaces. We've invested in regreening urban spaces. So We've also looked at reforestation. We planted over 1 million trees in across the country, across the region actually. We're really proud of this work. We have also been working with the Kenya Forestry Services. You probably have seen some of the videos that were running earlier, looking at how we can restore the Gong Road forest ecosystem, where we spent over 170 million shillings just to improve the forest. We've fenced the entire forest. This is the sanctuary side of the forest, to make sure that people can have a safe space to take their families and spend time just enjoying the greenery of Nairobi. And this continues across the region as well. In terms of education, we've always had a big focus on supporting education. We issued over 440 scholarships last year. We look at the number of vulnerable groups that we are empowering in terms of getting jobs for meaningful work. And that touched about 38,000 women and youth last year. All told, the level of investment that we had in this impact initiative was 400 million, over 400 million shillings. And collectively, we impacted over 300,000 new lives through these different initiatives. So this is really just a series of the different awards that we have picked up in 2025. Quite a number here indicated for Kenya and Mauritius, Uganda, and Rwanda and Tanzania. And these are really just a recognition that actually the things that we are doing are getting noticed, and it is really positive to see. So our summary highlights for the group: 60 billion shillings in total operating income, that's up 18%. PBT was up 22% at 24.1 billion shillings. The profit after tax, 19.8 billion shillings, that's up 22%. That's a number to look at when you're looking at distribution. And then net loans and advances up 7%. Very strong growth in customer deposits to 484 billion shillings, up 17%. The absolute increase in the cost of risk was just 0.3%, but the cost of risk was at 2.9%. Our return on equity ticked up 18%. The absolute number in terms of increase was 1.6%. And the return on assets at 3.2%, also ticking up positively, about 0.3%. Against this backdrop, then, we've had a 25% increase in the dividend per share at 3.75, so that's a good story for our different shareholders. Right, so looking at the individual subsidiaries, Mary, do you want me to continue with this? Okay, very good. We have to be careful here. So looking at the individual subsidiary highlights and how this has been cut up across, or the contribution has come from the various geographies in which we are operating. So I'd mentioned earlier that 24% came in from subsidiaries in terms of contribution to PBT. 30% in terms of the total assets. But looking at our common customers, the business that we are doing across the borders, that has gone up 76% from the 2024 number, and we are at $10 million that we consider cross-border business revenues. In terms of the individual contributions, then you will see the way the pie chart has been sliced up. So Kenya, 76%, that's up from 72%. Bank One, which is our joint venture in Mauritius, at 3%, slightly down from last year at 5%. Rwanda, 13%, down from 16%. Tanzania, a similar level at 5%, down from 6%, and Uganda, the same level at 2%. So individual countries, I talked about 5% expected growth across the region. You will see Kenya's economy is expected to grow by just under 5% in 2026. Big drivers for this growth are expected to be in agriculture, transport, finance, and construction and mining. So with Kenya contributing 76% to PBT, this is how the numbers stacked up. Total operating income up 22% to 40.4 billion shillings. PBT was up 29% to 17.4 billion shillings. Customer deposits, strong growth there, 15%. Absolute numbers, 45 billion shillings, very strong number. And then flat on the loans and advances, reflecting some of the constrained credit to private sector that we have been reporting across the industry. The cost to income ratio was strong, again ticked down to 40% from 41% previous year. The cost of risk up at 3.3%, but a good story on the return on equity at 20%, and similar story on the return on assets. So strong liquidity again at 55% compared to 47%. But that also reflects some of the balance sheet adjustments that you will have picked up already from the story we are telling. So the other element I would highlight here is the CASA ratio at 43%, which is really telling us that our customers are choosing to transact on our platforms and are keeping current accounts and savings accounts with us to facilitate that. So really strong growth out of the flagship business in the portfolio here in Kenya. Two key areas that we saw in Kenya that did very well. Our wealth management business, you will recall, this is roughly 4-year-old business now, and it has grown from strength to strength. In terms of assets under management, we were just shy of 100 billion shillings, which represents almost 3 times growth in year-on-year from 2024. Total revenue as a result then picked up. So from 120 million in 2024, we reported 565 million shillings in total revenue from that business. So very good focus there. Obviously, this is a response to some of the macros that we had seen playing out in the Kenyan market. And this is a business we are continuing to invest in, looking at how we can expand this into the region to support customer interest in this space. The second business is the bank assurance business. Again, another very strong story for us in Kenya. Our total revenues up 15% to 549 million shillings, and PBT commensurately up 20% to 384 million shillings. Our ranking is in the league here of bank assurance companies continues to improve, and a very well-led business that we are looking to continue to grow as we increase our customer numbers. So we continue to see synergies across our different businesses as we grow the bank assurance business. Turning to Tanzania, and yes, there was a bit of a hiccup towards the tail end of the year last year, but growth projected to be 6.3% in 2026 for Tanzania, driven by the traditional sectors of tourism, construction, agriculture, and industry, and also underpinned by mining. As mentioned, a 5% profits before tax, very strong growth in our total operating income, looking at trade finance in particular, which did well for us in Tanzania. Net interest income also grew 19%, looking at strong growth in credit as well, though PBT was partly impacted by some of the provisions we had to take towards the tail end of the year, as we saw some challenges in credit. On the total asset side, that grew by 17%, driven really by loans, while the net NPA decreased during the period, showing the levels of provisions that we were taking. Deposits grew by 12%, and our CASA ratio was still strong at the 40% mark. Looking at Rwanda, this is another strong growth story, 7.5% growth expected in 2026. Big focus on industrial growth, agricultural growth, and a lot of investment in the digital space and the service sector. So it remains a strong contributor to our profits before tax at 13%. And you will see that in local currency, it grew by 23% in terms of total operating income, even though when you translate it into Kenya shillings, that only looks like 2%. But very strong growth in local currency. This was on the back of growth in our credit portfolio, and that has driven net interest income up. And as a result, we have seen strong performance coming out of that market on the balance sheet side. Non-funded income, however, was a different story because we saw some restrictions that were placed, particularly in the foreign exchange market by the regulator in Rwanda. And that has really constrained the ability of banks to actually conduct foreign exchange business, even though it has led to price stability for clients. Our operating expenses saw a decline during the period. In local currency, it was an increase, of course, but as you translate into Kenya shillings, that then looks like a decrease. But our return on equity was resilient, still at 21%. Growth and balance sheet growth was also very strong at 26%, both through the loan book growth as well as the deposit book, which grew to the equivalent of 65 billion shillings, a 24% growth. Uganda, again, strong growth expected, 7.6%, driven here by domestic demand that's rising, expanding services. We know about some of the work that's going towards fast oil. We're looking at improved agriculture and further investments in infrastructure. So it maintained its contribution to PBT for the group at 2%. And this is a business that continues to make great strides in terms of penetration. We've invested significantly in the customer experience for our customers in Uganda and are continuing to do so, even as we now really step up our customer acquisition and balance sheet growth. So this has driven operating expenses up in local currency as we expand our reach and continue to invest in systems. And the PBT was largely flat in local currency with just a 1% growth. But you will see the translation resulting in the 24% increase in profit before tax. A strong growth in our customer deposits at 44% from 27 billion Kenya shillings equivalent to 38 billion Kenya shillings equivalent. So Mauritius, as I mentioned, is a joint venture for us. And this is an economy that's expected to grow by about 3.4% in 2026, again supported by its traditional sectors, in services, in construction, in tourism, and well-managed inflation and resilient domestic demand. It continues to contribute 3% of our profits before tax. We did see a decline in total operating income. This is a market that is very sensitive to global macros. So lower yields have driven a lower performance in terms of operating income. We also saw only marginal growth in non-funded income. Again, even there, you've seen some constraints on the foreign exchange side. You've also had to really look closely at fees to remain competitive. So we In local currency terms, however, there was a 4% increase in the PBT, and the balance sheet growth was driven by deposits, which has improved our current accounts and savings account profile on the balance sheet in Mauritius. So that's the summary across the region in which we are operating. Of course, within that, there are also other non-bank subsidiaries that have contributed to this. We haven't told that story, but this, again, is the slide that I had shared earlier in terms of our group summary. And in terms of other financial metrics that we look at, our earnings per share up 21% from 8.9 shillings per share to 10.8 shillings per share. In terms of book value per share, that has moved up 17%. And in terms of dividends per share, up 25% to 3 shillings 75 per share. So you will have seen, obviously, reported on the stock exchange, the performance of the share, the I&M share. And we saw this close at 42 shillings 50 in December, which represents an over 17% increase over the previous year. Now, what do we see for the medium term? So looking through the 26 period and slightly beyond. So we see in the medium term that our loan book growth will improve. Yes, we reported 7%, but all of the different initiatives we have across our different business segments, we are targeting to see anywhere between 12 to 18% growth. Deposits, similarly, expected to remain strong. We reported 17% growth in 2025. We are targeting between 15 and 20% in the medium term. Improvement in the loan NPL side, despite the growth we are envisaging in the loan book side, we're expecting that to remain between the 8 to 10% level. And our cost-to-income ratio showing efficiency, we are looking to bring that down from the 46% level currently reported. We always want our subsidiaries to contribute more and more to the PBT mix. It's presently at 24%. Barring currency movements, we are expecting that to rise to 30% in the medium term. Our ROE, we have said before, we want to get better than 20, so we're expecting to land in the 18 to 21% range, and return on assets to remain strong at between 3.1 to 3.5%. So that represents our story. I'll leave us with this slide here as we transition to the next phase, which will be led by David. Let me invite Mary to lead us from here. Thank you, everybody.
Surely those numbers deserve a better round of applause. Thank you so much, Kihara, for taking us through that overview. Without further ado, allow me to invite Kihara back on stage. Now we'll open it up to the discussion with the analysts, with the media in the room. Allow me to also invite David Ngata, our Group CFO, onto the stage, and Shamir, our Retail and Business Banking Director, to come on stage for the Q&A session. And as they come up, there's somebody I did forget to introduce, who is our Group Head of Strategy, seated right at the back, Caroline Inunda. Just let's recognize her. But Karibu. We also have our Head of Finance, Billy, sitting at the back. Karibu sana, Billy. Welcome, Kihara, David, and Shamir. We also acknowledge our followers online, and they're saying, we like the numbers, and then we see you. So that's a good indication that we are actually serving our customers right. So I'll open it up to questions. Please, let's have the mics going around. Let's have the brave analysts and media in the room to kick us off with questions. There's a question right there at the back. Just simply introduce yourself and ask your question.
So I'm Christopher Chege, from a junior analyst at Mongo Capital. I have several questions. So, so the first one will be on the contributions of the subsidiaries. So Kenya still contributes about 76% of the group profits, despite the strong growth you have seen from Rwanda and Mauritius. So what is the roadmap to increase the subsidiary contributions to about that 5% to 40% of the profits before tax? And are there plans to expand into new markets such as the DRC? The other one is on government securities and loans. So holding of government securities increased by 81% to 164 billion. While the net loan growth was about 6.67%. Is this a deliberate shift to reduce risk or a response to weak MSC lending conditions? So the other one is on the NPL ratio. So the NPL ratio is around 9.9%, below the average of 17%. So what specifically drove this performance, and are you seeing sufficient loan uptake in the current environment? So the other one is on ongoing consolidation in the banking sector. So given the ongoing consolidation in the banking sector, is the group actively considering acquisitions? And how do you assess the competitive pressure from the South African and Nigerian banks expanding in Kenya? So then
oh wow, there are plenty. So sorry, your last one?
3 more.
Wow, okay. Let's pause there. So we can take the first 4,
okay.
And then we can come back to round 2. So the first question there was contribution of subsidiaries, and I'll ask David perhaps to speak to that, and the roadmap to increase that contribution.
Thank you, and thank you for your questions. So on the contributions of the subsidiary, I think on the outlook we've shown for 2025, the regional subsidiaries contributed 24%. And in the medium-term outlook, we are looking at between 25 to 30. Now, that said though, it's the Kenya performance or the Kenya contribution, we have to dimension that, and I think there are 2 slides we shared, which in Kenya, we do have non-banking subsidiaries. So yes, it's true, Kenya is contributing 76%, about 10% of that is non-banking subsidiaries, and I think we showed 2 slides around how well our wealth management business is doing, where we are showing that revenue has grown about 9 times from 60 million at the beginning of Amara 3 journey to about 560, and our bank assurance, which has grown its profitability by about 48% in the same term. So it's not that, yes, Kenya continues to be a flagship franchise for the banking business. We have other non-banking business in Kenya that give us non-funded income, and those are growing within Kenya, and we do have plans of moving those regional as well.
Okay, great. Thank you, David, for that. The second question was on government security and loans, and deliberate reason to reduce risk there. Maybe David, you can take that as well.
Yes, so we are in banking business or financial sector business, and we cannot let our balance sheet sit idle. So that's the one thing we have to make sure that our balance sheet is working harder. And in the overview slide, we did show that our return on asset has increased 30 basis points from 2.9 to 3.2. So what drives that? We did see our customers giving us more deposits, our deposit growing 17%. And as we scan the environment, and I'll link this to the question, to the third question, and then I guess you've asked around the NPL. We have to be careful how we are underwriting to make sure that the quality of our loan book is a competitive edge for us. So when we didn't see across the region, not just in Kenya, across the region, as good as a strong pipeline where we could deploy this, then we had to deploy it in government securities. Is it a deliberate strategy? Is this the way we'll always continue to do? No. If the right opportunities come, we're going to deploy those funds into growth in loans, and I think we are projecting to show in the medium term growth in loans of 12 to 18%.
Okay. Thank you, David. The ongoing consolidation, that's a big question, mergers and acquisition. I think Harry can take that one.
Yes, so it's an interesting choice of phrase. It says ongoing consolidation. I think, yes, there has been an acquisition by an external player of one of the banks in the country. I think the opportunity to get efficiencies in the banking industry continues. East Africa, Kenya in particular, remains particularly attractive to external players. So we expect that you're going to keep on seeing external participants looking for opportunities in this market. For our landscape in Kenya, and whether we can see actual consolidation between different banking entities, that still remains to be seen. The early round of capital increases that have been brought in by the regulator would have expected would drive consideration for further consolidation. That hasn't quite happened, and there are bigger increases in capital that are required. We expect that should perhaps lead to opportunities for consolidation. I expect to see it perhaps in the second tier, third tier level, where the pain would be felt a bit more, and it would make sense to actually consolidate and get bigger entities. I think that recent activity in M&A over the past few years indicates that it's far better to see larger names actually coming together to gain or grow market share and really tease out efficiencies. So it is something that we continue to watch. As opportunities arise, we would certainly look at them. We expect that others are doing the same, but I think you need some bigger triggers to be able to drive that.
Thank you, Kihara. Shall we continue the second round? All right, so we have some questions on that side. Let's pass the mic. And as we pass the mic, there's a question here from Tanzania online. How much was the increase in capital, and what are the specific plans to improve return on equity for Tanzania and Uganda? I think David can be answering that even as we get to hear from Mwango.
Thank you. So in June of last year, we did all right, I'll try again. So in June of last year, we did support our business, our subsidiary in Tanzania. We increased our capital there by $5 million. That's about what, 650 million Kenya shillings. And that was driven by the increased business opportunities that we were seeing in Tanzania. And as you'd imagine then that pumping in new capital to a subsidiary would be return dilutive. Actually, what we've demonstrated and what the results for 2025 have shown us is that actually Tanzania was able to deploy that capital much, much quicker, and we've seen that return on equity increasing to 14.6%. With Uganda, Uganda is an interesting country or market in terms of the regulatory environment, where the regulator has set a very high bar for the absolute minimum capital, and therefore our return on equity for that reason is on the lower side in the single digits, but the projection is that that should move into low to low to mid double digits in 2025. Our business there, as Kehara observed, we have made a lot of stride in market penetration.
Okay, thank you, David. That was online. Go ahead.
All right, first of all, I'd like to congratulate you for the beautiful set of numbers. I think rarely do we give credit where it's due for the work that goes around it, so thank you so much for that. My question is actually to the retail side of things, because I think Mwango has asked all the questions we wanted to ask, and he still has 6 more. Anyway, the retail is quite important from the presentation we've had from the CEO, but it's clear there's a bit of pressure there, because looking at the numbers compared to last year, there's a bit of a shrink that we have seen there, some pressure on it. So I wanted to ask you what's happening. I don't know whether you can also combine it with the CIB business. Looking across the industry, you seem to have taken a slowdown on it, or I don't know what's happening. I just wanted some color on that, because, I mean, when you started, you had a great campaign, especially that attracted a lot of retailers. Some people who do daily business love you guys because their transactions are saved a lot. So it didn't figure out on the numbers. Just wanted to ask some color on that.
Shani, yes, go ahead. And I think tied to that, there's actually a question for you, Shani, here online. What is the outlook on deposits growth for RBB, as well as the CASA ratio? So you can answer collectively.
Yeah, thank you. So yes, from those numbers you saw, there was a bit of a shrinkage in terms of contribution. However, a large part of that is to do with actually the FX translation from the subsidiaries. So if you look on the different businesses, especially the large contribution that comes from Kenya, actually year on year there has been, continues to have positive growth. Customer numbers are increasing. We're also seeing this giving us the benefit of a lower cost to serve because we're getting the scale in terms of the customer numbers, and the transactions, etc., are increasing both through our physical presence as well as through the digital products that we are offering on our apps. So that's actually shown growth. Similarly with our deposit book, it did decrease, but it was actually a lot of the decrease was actually in the high cost space, where some of it transitioned to the wealth management side because of just the yield that you get in that offering. But our CASA book actually has increased year on year, and our ratios actually moved from about, it was for that particular segment was at about 38, it's now at about 48. Yeah.
Okay.
Maybe if I can also add to that question, is the pie will always equal 100%. And therefore, I think when you say retail, CIB have decreased, we are talking about those businesses' contribution to the overall group profit. But one of the things which I think clearly needs to come out is the contribution of our non-banking business, that and the contribution of our treasury business to the overall group profitability. So we have had strong growth there, in as much as in absolute terms, the retail business and the corporate business, that profitability has grown. But in terms of contribution, I think that's what your question was directed to.
Thank you, Maina. I hope we've answered that. There were a few more questions. I see Mark there. So we can take a few more and then we can respond. Mark, go ahead.
Hi, my name is Mark Kotani from Swalanyeti. I'm just looking at how much most of the banking products and accessing of loans is going to the digital side. Yet, like many other banks, I'm sure you guys are also doubling down on opening more physical branches. I'm just wondering what form are the branches going to take, given more services are being accessed on digital? And also looking at where technology is going, there's a lot more talk of AI. I don't know how you guys are integrating that into how that physical and digital banking is going into the future.
Thank you, Mark. We'll note that. Jimmy, I see you at the back.
Hi, thank you. Good morning, everyone. Jimmy Bogo from Citizen TV. A couple of questions. Number one, just looking at your income, one of the things that we have noticed is when we look at corporate and institutional, their contribution to the overall operating income has shrunk by about 12%. Could you just talk to us about what is happening in that space, and also what's happening last year, and with all the shocks that are coming out of the Middle East, what is it likely to happen in that space? And number two, on your treasury business, we are seeing rates that are coming down. There are some that expect that to go to as low as 7% this year. I just want to know how are you planning your investment around that? And in terms of headwinds, could you, Kiara, if you don't mind, could you just speak to the headwinds of 2026?
Okay, I think we can take those. So, yeah, we can start with the digital question.
Yeah, so the way we see it, we see the physical expansion and reach as complementary to the digital expansion that we're doing in the digital space. We see both really as enablers to each other. What we've seen is, even as we're expanding our reach in certain markets and in different towns, that there's a surge in actual digital onboarding of customers when we have physical presence there. What does the branch of the future look like? It's really a branch which basically is where you will have enriched conversations with your customers, understand their vision, their objectives, and trying to work with them to provide the right kind of solutions to support them on that growth. So it'll be more conversational, and we're seeing that the branches are becoming less as a transactional in nature, because obviously a lot of the transactions are being done through the digital play, but the branches are becoming more of a conversational element. So we see them both complementary, and the expansion on both fronts will continue for the foreseeable future.
Okay. Thank you, Shamir. Jimmy's question was around the income contribution for our corporate and investment business, as well as the Middle East shocks. So, David. Yeah.
Okay. Yeah, so on the contribution for the corporate and institutional business, I think that's a question that Maina had asked more or less earlier, where I was saying the growth, just the proportionality. There has been growth in our corporate and institutional business year on year. However, what you're looking at is proportion contribution to profitability. And we have had, especially our treasury business and our non-banking subsidiaries, we did dimension the wealth management business and the bank assurance business, which has grown, which has contributed more powerfully to the growth for 2025. And therefore, given that everything that we have to add it all up to 100%, although there's absolute growth, that proportion, that's the reason why the proportion has come down.
Yeah, so, and I think in addition to that, and you touched on the trade finance aspect, so we continue to be a leader in the trade finance space, right? We still, as I&M, open roughly 40% of all the LCs in the country. And in terms of value, that has now gone up. We're doing almost 10% in terms of value of LCs opened. As you may know, we were one of the early banks to get into the government-to-government space, supporting the oil solution for the country as well as the FX side, and that continues to be a strong area for us. We have been looking at different sectors that we are growing out, and you saw the contribution in the 2025 numbers came into about 24% from these new areas. We're continuing to enhance our strengths in that area. So trade finance in particular, we want to do further automation. We're looking at other products in that space. We're looking at the leasing side of the business to see how we can continue to strengthen the contribution of corporate and institutional banking. When we say that it is to really develop our leadership in our core segments, that's what we are looking at. Being good at the traditional areas we want, keeping our clients, as well as looking at new sectors. Now, understandably, some of the macro challenges that we have been seeing in the market have affected the corporate loan book growth, and we have been particularly deliberate in saying how we are going to take risk in the corporate book. Tied to that, of course, is if you see a contraction in credit, good quality credits out there, competition becomes stiffer. It translates into price wars, right? And you will see people bidding to take clients away because of simply price. We look at value, not just price. So we really focus on what is the entire ecosystem we have around a corporate client and how can we actually add value to them and protect that as well as we can. Now, how does that also link into the headwinds that we're seeing then in 2026? So yes, we got some interesting surprises come, the new year. You're over there looking at celebrating New Year with your family, and you suddenly see a rise in geopolitical, concerns, right? And that has then extended for the whole of the first quarter. We have seen this really going on. The Middle East challenge that is continuing to play out. We keep hearing references to a short war, but that is playing out even longer than I think they expected. It's taking a different shape from what perhaps they had anticipated, and you cannot be really certain about the direction that it will take and which players will then get involved, right? So this is something we continue to watch carefully. It has elevated, obviously, our risk profile from the connection we have with that corridor. We already see that in the G2G structure that we have, which is predominantly linked to the Middle East. We expect that is going to translate into macro issues as well, right? We have the pass-through that comes in from oil into via transport, into prices, and eventually into exchange rates. So I think perhaps the MPC that we have in April is going to be one of the most closely watched in Kenya, because it's going to signal what data is telling us about upcoming prospects. We have seen, at the pump, some confusion. We're not sure what exactly is the true story there. There may be some supply restrictions already being felt, but the challenge is that it could get constrained even further, right? And then it has a significant impact right across the economy. What other headwinds then, other than the macro side? Yes, we still remember I talked about the capital side. What does that actually mean in terms of opportunities? You're seeing a very strong growth story in the East African region. What does that mean in terms of people looking into East Africa and opportunities there for sharpening competition? So that's something that we also look at. Obviously, the impact of the digital space, and I know that there was a question around AI and how where we're focusing on. We appreciate that we were one of the early movers in the digital space, right? We now have a team led by Eunice here that's over 170 strong. This is developing the next frontier of digital banking products for us. We appreciate that these investments are then going to drive how we actually position new products for our customers, new channels for engaging with the bank, but it also presents new frontiers for risk for us, right? And we have been also very diligent in investing in our cyber protection as well. We were one of the early adopters actually of AI in cyber protection. But we appreciate that this is a changing thread. It's daily, it's really dynamic. So we have to keep on looking at what that threat landscape looks like and protecting ourselves, because as we continually become digitized in the banking industry, that is something that we have to be careful about, because ultimately we're dealing with public money. So those are just some of the things that we continue to watch.
Thank you, Kiara, for that comprehensive response. I see that some encouraging comments online and some more questions for David and Shamir. So solid performance for INM for 2025 and the goals for 2026 are commendable and encouraging. Thank you for those following us online. A question for David: what is the planned capex for 2026 across the markets? And two questions here for Shamir. Which sectors do we see ourselves that will drive loan growth for this year? And what do we consider as new business lines for RBB? Loan growth. Yeah. David, we can start with you, as we also nudge the analysts in the room to be ready with their questions.
Right. Thank you. So yes, we are continually investing and reinvesting in our businesses. So for 2026, we'll continue expanding our distribution network through opening of new branches. On top of that, we are continuing to enhance our risk management platforms, our AML systems with the increased risk, especially due to the dislocation of the war, as Kiara has covered. Somebody asked a question around the declining rates, and we really have to increase our capability around how then we are managing our asset to liability operations. So we are making improvements, one in physical locations, in applications and systems, and all of that we are going to be spending somewhere between $10 million to about $15 million in 2026.
Thank you, David. Shamir?
In terms of loan growth, the focus areas are really on when it comes to the retail space is on more on the short-term digital loans. It's not a balance sheet play, but it's more velocity, because these are generally short, they're repaid and taken again. And usually it's targeting, the smaller businesses, individuals, who are looking for some short-term liquidity before their next paycheck, or if they're looking for loans for, buying stock for sale, and then, they take the loan and a week later, etc. So that's really the focus when it comes to the loan growth for the retail space. As far as market, the sectors, the focus continues. We still have, 80% of, the workforce as a country and in the region directly or indirectly linked to agri. So there's a lot of opportunity still in this space to offer the right kind of solutions towards the value chains within the agri space. We're still seeing a lot of trading in the smaller MSMEs, so that will continue. We're seeing a new emerging area where smaller businesses are also entering into the green transition space, whether they're looking at putting up kiosks for battery swap stations as a business, or looking for solar supplying solar irrigation pumps, etc. So we're looking at these kind of spaces to help support these MSMEs go in these kind of sectors.
Thank you, Shamir. Let me turn back to the room. Question at the back. Go ahead.
My name is Patrick Alshula from Nation Media Group. My first question: we have seen really high liquidity in the market, and at times CBK stepping in to mop up billions of shillings daily. what's behind this, and why are we not seeing banks really respond with a faster rise in their loan book as far as lending is concerned, especially that we have actually migrated to a new model of lending? On the shilling, I'm just curious what your outlook is, given the mixed signals that you are getting from Middle East as far as the crisis that is there is concerned. Have we reached a point where we are seeing some maybe importers start to build up dollars in anticipation of volatility around our exchange rate? I have another question regarding Rwanda. Kihara, you mentioned that the that were introduced really constrained forex business. Probably if you could explain how and maybe give an outlook on what do you see playing out this year as banks try to adapt with the new rules. And then finally on bank assurance, you have an interesting story where really we are seeing strong growth around bank assurance business. If you could give some details around what is driving this growth and perhaps new areas that you see besides just things like insurance that is tied to people tapping loans. Thank you.
Thank you. I think let's take those four first. We can start with the lending acceleration. Seeing a slow acceleration across banks.
Yes. So thanks, Patrick. So when we look at the high liquidity, what you call the high liquidity that you're seeing in the banking industry, yes, and I think your question was more really about the amount of mopping up that is happening by the central bank. I think we need to remember that not too long ago, it was actually the other way around, right? There was a lot of injection that was actually happening into the industry, right? So this rebalancing will happen from time to time. Now, obviously, if your credit to private sector is a bit constrained, then the utilization of liquidity into loan books then becomes constrained, and you will see a picture like ours emerge. And you will have seen that for example, our loan to deposit ratios came down to 63% from the 70s. What that is telling you is, like David said, you can't keep your balance sheet idle. You have to pivot, put it into government securities. That drives up your liquidity ratios, right? Because you're still getting earning assets growth coming from all of the deposits that you're mobilizing. They have to be deployed. You mentioned why that isn't translating to loan book growth given the new model. I presume you're referencing the linkage by banks now to CBR. I think what the CBR linkage has done is to improve the direct link to monetary policy. So if then we were to consider that this is still early days, I think we only started March effectively for the entire industry, where you have floating rate Kenya shillings being linked to the CBR, then you'd expect that as some of that signaling gets stronger, then depending on whether credit to the private sector is actually growing, if the demand out there for credit is actually growing, then you will see banks starting to lend more. We also have seen a different type of lending emerge over the years in the digital space, and Shamira has talked to digital lending. We mentioned that we saw over 20 billion shillings that had been disbursed in digital channels, but in the short-term lending, which is your high cycle loans, you are actually getting somewhere in the region of about 5.5 billion shillings. So you're still seeing borrowing happening. It may just be short-term, but the spot balance that you have then at the time that you're reporting tends to be small, right? So you are still seeing a lot of borrowing. If you look at it in the cumulative, it will still be a lot of borrowing happening in the retail space and the MSME space, but it may not be translating to the actual spot balances showing a rise. You asked the question about exchange rates, what the outlook for that is. I think that We have had a very stable currency for now quite a while. The structure that had been put in place to support the oil imports and currency stability has served the market well. We now have to consider the impact from the geopolitical crisis that is playing out, where that pressure is coming from. So the expectation typically would be that there would be pressure on the currency, but so far it seems to have held up, even though it's still early days in this. So let's watch that one. We certainly are watching it very closely to see whether it is translating into pressure for our customers and how we can support them through those kind of movements. The Rwanda question, basically what the Rwanda market is doing is responding to the same kind of pressures that we had earlier in Kenya. And that has then meant that corridors have been put in place. I think you can't go past, I think it's 5 Rwanda francs, or 0.5 Rwanda francs, I think it is, on the market rate on a day-to-day basis. So that really constrains how much you can actually trade, right? Because outside the supply that is then coming into the market from your traditional sources, customers in the services industry, the traditional exporters and all, it's difficult to then take currency positions if you don't actually have commercial underlying businesses that's running. So that's what has been constraining the performance of the FX in the markets. How will this change? Ultimately, it will be about what pressures are felt by customers and how liquidity improves in the market. Right now, it's about protecting the currency, and we have seen the impact translation has then had into our numbers. But again, we always focus on how we can support our customers through that cycle and how we can engage with the regulators to drive better performance in the markets. Have we covered all the questions?
No, there's a bank assurance opportunities.
Bank assurance, yes. So this has been a good story, as I said, and has been growing. We started our bank assurance business back in 2014, right? One of the first banks to actually do so. We've always felt that banks getting into insurance gives greater impetus for growth in the insurance industry. Banks are better trusted, really, having had a long engagement with clients, being highly capitalized, highly regulated. It means that customers tend to trust us better when it comes to selling insurance. That's not unexpected. Where we have seen the growth come from is linkage, obviously, into our corporate and institutional banking side. As we look at all of the import business that we run, the general insurance that we do, because we obviously have collateral that needs to be insured and so on. But you have seen a shift that has come not just simply from saying, run it through us, but actually, here's how I can help you look at your insurance profile and give you more bang for your buck, right? So that advisory has really helped customers to trust banks more, and we have seen growth in that space. Now, you mentioned the second plank. Is it coming from credit insurance? Yes, indeed, in the retail space, as you grow your loan book in unsecured lending, you expect to see the credit life that is associated with that also translate into greater insurance penetration. But actually, because we are a growing business in the retail and MSME and business banking space, that is something we are actively promoting, looking at new solutions that we can directly sell, particularly via digital channels, to drive penetration and ultimately protect our clients as they go about their daily lives. So this is where we expect the growth to come from.
Thank you, Kihara. I think we can pass the mic around. I see about 2-3 questions.
Tony from Money 254. My question is on behalf of small investors. 22% growth in profit is quite impressive and an 18% return on equity. But I wanted to ask your outlook for 2026, considering the key drivers for that growth, and you have talked a lot about the risk in the geopolitical issues as well as the macros. What will be your message or your outlook on the sustainability of that into 2026? And can you expect that to be the new baseline moving forward?
Thank you, Tony. We'll take at least 3 more. Let's fix the mic.
All right. My name is Maureen Kirigo from NCB Investment Bank. I just had one question regarding your financials, especially 2024. Seeing here that the numbers are restated, so maybe you could just unpack that.
Okay, thank you, Maureen. I think we have one more on the side. In front here, yeah.
All right, thank you so much. Congratulations on the good stand-up performance. My name is Maria Wendell from Old Mutual Investment Group. My question is outlooks on 2 things. Number 1, the dividend payout ratio. Do you plan to maintain the high levels? Number 2, congratulations as well on the wealth management business side. What's the plan moving forward and its sustainability? Thank you.
Okay, I think we can take those alongside some questions coming online. So we can start with the 2026 outlook around sustaining the dividends for small investors.
Yes, so thank you for that question. Outlooks are always difficult to stand by, let me say, right? We look at our planning periods, we look at what we are targeting, and based, of course, on what we have also achieved. So yes, indeed, we talked earlier about where we're expecting to land in terms of growth. So that trajectory around the 22% is still what we are looking at. But as Mike Tyson famously said, everybody has a plan, right, until you get into the ring. So we have to make sure that we are looking at any of the headwinds that are coming and looking at how we pivot. Part of the growth that we saw in 2025 came from pivoting to make sure that we can take advantage of rate changes and make sure that asset and liability management is strong so that we can deliver the ambitions that we had. So really in terms of outlook, that's where we are, and we're looking to certainly sustain it through the next cycle as well as 2026. The restatement question I'll leave to David, and then I'll tackle the wealth management question.
Okay. David, go ahead.
Okay. Thank you, and thank you for noting that. So in 2024, we have had to restate or classify differently some of the items that we had reported earlier. And particularly, this is more so to give better disclosures to the investors. So when you look at our balance sheet this year, for instance, we do have investment properties, some in Kenya and as well as our Rwanda head office. Previously, that line of disclosure was not there. It was aggregated together with property and equipment. Now we are showing it separately. We've separately dimensioned what was our derivative financial assets and liabilities on the face of the balance sheet, so then you can see that and appreciate, rather than having that included in other assets and other liabilities. As well as if you go to, there's one industry-wide restatement that you'll see for all of the banks, which has to do with the cash flows and the way the cash reserve ratio was being accounted or was being treated, whether that was accessible to banks or not. And somebody did ask a question around the liquidity question. And when there was a liquidity tightening, it was demonstrable that banks could access that cash reserve ratio for their daily liquidity. Yes, you have to maintain a certain balance over a period of time, and therefore that now has been properly delineated as a part of cash and cash equivalent. So those will be the drivers of the restatement, and to help the financials be better understood by the investors. Thanks.
Yeah, Carrie can answer that, and then we have some questions for Shamir as well.
Okay. So Mary, thanks again on behalf of all the 3,601 staff in the group. We are really thankful that you're noting all the hard work that they have done to deliver these results. The wealth management business has been a very strong story. I mentioned that we're just under 100 billion shillings in terms of assets under management. This has been driven, and Shamir did talk to this. Obviously, people are looking for returns, and the more liquidity they have to deploy, they're looking at where they can maximize yields. So we have been looking at how we can provide greater access to these solutions via our platforms, and we have actually just streamlined that on our I&M on the go platform to just make it easier for people to be able to access these different asset classes, different opportunities directly via the solutions that we're providing. Obviously, there is always innovation that's going on in terms of products. We are looking to launch yet another fund very soon. We are just going through the clearances for that, but it's going to provide yet another opportunity for clients in different currencies to continue accessing some of these higher yielding solutions. But we're also expanding the products to other markets, right? So we have just started the wealth management business in Uganda, and we're looking at whether we can also do that across the region so that we can widen the reach for investors in these markets through this. Now, of course, there's the other element of accessing international markets, not just products in the domestic markets. So we're continuing to facilitate access through to those other markets as well. So it's a good growth story, and we expect it to continue producing good results.
Great, thank you, Kihara. So some two questions we'll take as we start to wind up on our Q&A. Question for Shamir here. How is the bank structuring its green lending approach to ensure early stage climate tech startups, such as those in the e-mobility, can access funding, including through appropriately sized facilities alongside larger corporates? The other question is, how is the group safeguarding asset quality amid high interest and volatile economic environment as it accelerates SME lending? I think we have touched a bit on that, but you can expand. Shamir?
So yes, you may have seen even just recently we signed a partnership with one of the with SIDA, which is a part of the Swedish government development agency, on a risk-sharing partnership really for green transitioning. So as part of this efforts, what we're trying to do is come up with the right kind of product solutions for our customers, where they're looking into getting into the e-mobility space or already in it and looking to expand, and how we can provide them with the right kind of products and solutions, so that they can expand in this space, in this growing and interesting space, which is also very much well supported by the government policy. At the same time, we're seeing a lot of value chains within these spaces as the larger e-mobility sector basically puts up shop in Kenya and in the environments like Rwanda especially. And this is creating a whole ecosystem of other SMEs that are looking to basically support these aggregators. And with this in mind, we're seeing demand for certain solutions that really speak to that space. And with that in mind, we're trying to basically build our ability to deploy capital there. And that signing of the risk-sharing agreement is just one of many initiatives that we have to really support that sector. So if there are, businesses out there that are looking to basically invest in the e-mobility or other green, green transition projects, please feel free to reach out to the bank, and we'll be happy to support. We do have, we're looking to basically deploy almost 5 billion in this space over the next 2 years.
How is the group safeguarding asset quality amidst high interest and volatile economic environment? You can touch on it. I don't know, David, if you want to add on.
Yes. So, like I said earlier, the importance of the lending and looking at the short-term loans, trying to basically make sure that as you lend, you're trying to lend the right product offering to the customers. And sometimes customers, given their level of understanding, may not be the best place. So it's really advising them what they need. So looking at their actual working capital cycle. If they're looking at stock, you have to understand their business in terms of when do they sell this stock, when do they get their cash for selling it, and making sure that you tie up your repayment with it, so that you're able to offer them the product with the right kind of tenors, for instance, so that they're able to then take another loan and pay and maintain that habit. Because the biggest challenge with SMEs generally is diversion of funds. And so what that means is, they borrow for a certain product, they sell it off because they now have liquidity, but the loan is not due. They end up, using it for other assets which may not be generating the liquidity or the cash flows that they need. And then they end up with the challenge of how do they pay off when the loan becomes due. So a lot of efforts has been going on in terms of making sure that the products we offer align in terms of repayment to the repayment capacity of these businesses, as well as looking at those with some of the offerings. For instance, agri is a good example where, the cash flow cycles are very uneven because, depending on the crop cycle, whether it's livestock, if it's fattening, it has a very different cycle of cash flows. So offering them a monthly installment for such a business just doesn't make sense. You're not helping the customer at all. So working with them to provide the right solution so that not only are we de-risking our portfolio, but also helping the customer, in their growth trajectory by offering the right kind of solution so that we can grow together. That's part of it. The other bit is we do, again, work with various, partners to try and help de-risk our book. So we do work with different partners. We do have some already on board for some of these sectors where, the focus is on trying to grow the SME book or the agri sectors, and working with them on offering some de-risking solutions, so taking some risk participation, as well as offering technical assistance that then we basically deploy to our customers to help them basically improve, whether it's financial literacy or in other areas of their business, so that they can become a lot more resilient for their businesses, which would obviously indirectly support our portfolio.
Carrie, you wanted to add?
Yes. So once the money is out the door, we also have to monitor it, right? And what we're doing is looking at how we can use artificial intelligence to improve our risk monitoring. So early watch signals telling us when you're expecting to see some stress in a particular loan, and take early action. So we're looking at all of these different opportunities to really sharpen the way we actually manage retail credit in particular once it's deployed.
Okay, great. So before I invite my panelists to give their wrap-up comments, any pressing question? Okay, Mongo Capital is back. We don't want to lock them out, so we'll have that as the last question or questions. Then I'll invite the panelists to wrap up. I see we have another 6 more.
But it's just 3 more, not 6.
Go ahead.
So what was behind the positive 2.3 billion increase in other income? And what percentage of TZ does IMG own? Maybe you could provide structural guidance on how the business looks like. And the other one is on cost of risk in Rwanda and UG was negative. So why was this the case? And if it's due to recoveries, what would it be without the recoveries if normalized?
Okay, David.
Thank you. So I think how much do we own in Tanzania? Effectively, as a group, we own 95.5% of the Tanzania subsidiary. I think early this year you'll have seen the announcement that we did by 2 of the minority stakeholders. So the way we own the Tanzania business is back in the days, it was a subsidiary of I&M Kenya Bank, and when we prepare and we publish our results, you'll see the Tanzania consolidated there. And then the rights issue that happened last year, we did that at the bank holding entity. Then to the question on the cost of risk for Uganda and Rwanda. So I think when you look at those 2 countries, especially Rwanda, our net NPA is 0.2%. So really, anything that we recover will generally come back to the P&L because actually the gross NPA for both countries is less than 5%. So that's what drives that. And then to your question around the drivers for other non-funded income. So trade finance continues to be a very strong business for us. I've spoken about at least the 2 big non-banking subsidiaries, the contribution for our wealth management business and the contribution for our bank assurance business. And then when the yield curve is coming down, we will take a look at our portfolio, and if the opportunity arises, we did crystallize some of the bond trading income into non-funded income for the year. So that will be the drivers for that. Thanks.
Great, thank you everyone. That brings us to the end of the Q&A session, and I will ask panelists starting with Shamir, David and Kiara to just give out our closeout remarks.
Thank you all. So yeah, 2025 was a great year. 2026 continues on that journey. You see there are lots of opportunities. Yes, we do have the macroeconomic challenges and the geopolitical issues that we're facing that emerging, and we do continue to monitor that. But in these spaces, there's also opportunities within that. So the whole idea is, we need to take advantage of that, the opportunities that open up because of this. And we are already seeing some of those play out locally. I think just to give you finding challenges in the supply chain, because a lot of their raw materials come from the Middle East, biodegradable packaging, and suddenly you're seeing a lot more demand for that. So that's just an example of where certain opportunities lie. So with that, we will be having those tactical shifts to make sure we take advantage of those opportunities that open up and to deliver positive numbers going into 2026.
Thank you, Shamir. David?
Okay, thank you. Yeah, so again, I'll echo what Shamir has said. We are very pleased with our 2025 results. Firstly, to the customers who've given us the business that has enabled us to be able to achieve this set of results. Thank you to our colleagues who've worked really, really hard. I think that 3,601 of them. So again, thank you. And to you, the investors who've entrusted us with your capital, which is what enables us to be able to do what it is that we are doing. So again, thank you. Now, for 2026, we've done something which we haven't typically done in the past. We've given you a medium-term outlook. We believe we've built a business that has the resiliency, and despite the global headwinds, the macro headwinds that may be there, we are committed to delivering on that outlook. Thank you so much.
Thank you, David.
Thank you. So let me add my voice to thanking our colleagues who I'm sure are watching this online for the very strong set of results that we've had in 2025. And also thank our management, our boards for the support that they have given to the business. And of course, our shareholders right across our various markets and also in places like Rwanda, where we also listed, for the continued belief and support in the business. I think we have had a strong story in terms of our brand, and we are continuing to invest in that space. We are looking to really positively impact the communities in which we live and work. We are deliberate about how we sustainably generate returns for our shareholders, and this is something that we are continuing to invest in. So yes, David has indeed mentioned that we have done something different this year, which is to give some forward guidance. And what we are looking to do is work with yourselves as investment analysts to continually unpack that story. And I think the questions that we've had today have really helped to bring that out. So thank you very much as well. And thank you very much to all of you for attending our briefing today. And have a great day.
Thank you, Kihara. Before we let you go, we'll take a photo. Yvonne, you ready? And as we take the photo, a quick vote of thanks to all of us for making the time, both physically online and for the hotel for hosting us this morning. And a special thank you to our strategy, our investor relations teams, and our finance teams for putting this together. I have been your host, Mary Kidunji, also the Group Head of Marketing. So a round of applause. Do we want them standing, seated? Okay, great. We shall have the interview session right after this, and I believe we have more breakfast.